Tuesday. Hope everybody is okay. Market is trying to make a little bit of a rebound from yesterday. S&P's up about 40 points right now. NASDAQ is really the leader today. NASDAQ's up over 200 points, or up well over 1%. We're seeing VIX down about 5% today. Small caps up a little bit. So, yesterday's sell-off, you see so much in the headlines. I saw so much late yesterday, early this morning about yesterday's big sell-off. I mean, we weren't even down 1%. So, we have to take things into, kind of into consideration when that happens here. So, really not big market moves, but the market is trying to get everything back today that we lost yesterday. And what I think is happening here is just, we get daily news headlines, whether it's geopolitical risk or economic risk. The election is now only 30 days, less than 30 days away. So we're going to see this continued chop. So, just as we've talked about, you got to be prepared for it. I don't think just because we're rallying today, that means that we may not sell off later today or tomorrow. Or, tomorrow is actually pretty big because we get the Fed minutes from their meeting a couple weeks ago. And then we've got CPI and PPI on Thursday and Friday, respectively. So a lot going on. But what I am noticing right now, and it has been for a little bit, is volatility, not just VIX, not just overall volatility, but volatility in individual stocks has really picked up. And we typically will see that prior to earnings, right? And we'll see a jack up, a jump up in volatility. But we're seeing that now in a lot of stocks, even that don't have earnings right now. So I want to go through what I put in the headline here today, and I'd love for all of you to ask questions about a specific stock, and I'll pull it up on the screen here. But I want to go through how we determine if volatility in an individual stock is expensive. Is option premium expensive? And how do we know that, right? So understanding implied volatility and understanding the Greek that goes along with that, vega, is so critical. All right, first off, can everybody hear me okay? Boy, we got a lot of me's up there in the chat already. Okay, already about, want to do the spinning wheel. How do we know? How do we know if that spinning wheel is going to happen today? But yes, it absolutely will. So we're good to go with that. All right. Excellent. Sounds good, looks good. I appreciate that. If everybody also, if you have a stock you want to look at to see if volatility is expensive, please let me know. The first thing I want to go to here, guys, is something that we did this morning. And I want to do this review with everybody. Okay, for those of you that may not have been in one of our rooms, and we put a signal, okay, we put a signal out across multiple rooms today. But the one in my room here, and if everybody can see the screen, was in MPC. Okay, as we all know, energy stocks, oil stocks, have been all the rage over the last few weeks, with the price of crude jumping from roughly 65 up to about 76 or so a barrel. Many of these stocks have followed suit, or maybe it's the tail wagging the dog, who knows. But today, oil futures are down 4%. Okay, so many of these stocks, we have seen a big retreat in the price of those stocks as well. Actually, before I get to MPC, let's take a look here at VLO really quickly. Okay, and what I want to point out here is look at this chart in VLO. Okay, this is a 6-month chart. And if I start from really right here, which is May 17th, so I'm actually going back 5 months here. Let me change the color of that here, guys. Look here, here, here. What do we notice here? Okay, what do we notice here? Well, what I see is each time the stock would come up to these levels here, it was met with some really serious resistance. Does everybody see that? Excellent. Excellent. So looking at that, when VLO made a really, really big run off of this bottom here, when the price of crude really started to ramp up over the last several weeks, okay, this is September 9th right here, and then the real big move is right here, just at the beginning of the month. That's when, we really saw an escalation in the Mideast. Oil prices started picking up. And what do we see on this chart here? Let me hone in a little bit closer. I'll make this a 3-month chart. So what do we see here? Yeah, we see this approaching right up to the 50-day moving average again, where we know that saying past performance is not necessarily indicative of future performance. Well, if we look historically over the last 6 months in VLO, what do we see? We see a pattern of major resistance. So what did we do right here? This was actually Friday, 2 trading days ago. We bought a put spread because we were looking for a decline in the price of VLO, just based on those resistance levels that we see. We bought this put spread, this exact put spread that you see on the screen here. We bought that for $1.30 on Friday. Okay? Today, we exited half at $1.90, and we exited the balance of our position at $2.50. Literally 2 trading days. So this average exit is $2.20. So 2 trading days, because we respected the technicals that we use, and in this case, the 50-day moving average, and didn't get caught up in what you're reading in the headlines with what could happen to the price of oil and what can happen to gasoline and what can happen to all these stocks. Certainly we have to take that into consideration, but we obeyed the technicals. And in literally 2 days, we took out 70% in this. Does everybody see the rationale of why we took this position? Okay. Excellent. Now, let's get to MPC. And I actually talked about MPC for those of you that may have been tuned in earlier today. I talked about MPC on the Schwab Network earlier this morning. Look at this chart here. And I'm going to bring this out here to, this is now a 1-year chart. Okay? A 1-year chart. We talk about respecting technical info. Okay? Well, if I go all the way back here to, this is the beginning of the year, and actually the end of last year, 2023, and the beginning of this year, what do I see? I see some resistance right there. Resistance, resistance. Okay? And then what happened once that resistance was broken? Okay, we went all the way up here. We came down, and look where that support is. And look where that support is. Okay, these 2 areas, what used to be resistance now became support. That's a trend that we see very, very often. where former support becomes resistance or vice versa. Former resistance becomes support. Does everybody see what I'm looking at, what I'm pointing out there? Okay, excellent. So here we are. MPC rallied, came right back down again, rallied over the last week, 10 days with the rest of the energy space, and then today on just, crude falling 4%, this stock just fell out of bed. But where did it fall to? That same level. Okay, the stock is down, I want to say it was down 15% at one point today. It is now down 12%. It was down 15%. And what happened? People got scared. When I say people, what do I mean? Retail traders. How do I know? Well, look at this implied volatility. Skyrocketing higher. Okay, and if we put this over a longer time frame, outside of this event here, which was August 5th, seems like every day we're referring back to August 5th when the market really, took that big leg lower on the Japanese carry trade issue. Outside of that, even inclusive of earnings, I don't see volatility, implied volatility, any higher than where it is. So when I look at that chart, folks, if I'm just looking at volatility without even looking at what I may want to do with a position getting long or short, I know that option premium is expensive because the implied volatility chart is telling me that. So what do we want to do when option premium is expensive? We'd rather sell it. We'd rather collect money. When option premium is cheap, we would rather buy it. So just looking at MPC here, now I've expanded this chart to 2 years. And this is implied volatility in MPC. And again, I want you guys all, if you want me to look at a stock, to put in the chat here, and we can go through this same example with whatever stock you want to look at. But in MPC, if the vol is anywhere down here, okay, regardless of the position I may want to take, whether it's bullish or bearish, based on what I see there, I know that option premium is cheap. How do I know that? Because this chart is telling me. This is a 2-year chart of where option premium has been. And when we see it level off or bottom off down here, what do we see? We see these spikes. But we haven't seen a spike up here for quite some time. It is really at a really high level. Okay, one of the things about implied volatility that everyone needs to know, okay, it is mean reverting. It's one of those characteristics of option premium. Let me write this on here. Implied volatility is mean reverting. What that means is when it gets up here and up here, it is going to revert back to the mean. Just like when it gets down here, it's going to revert back to the mean. And you know what, guys? That happens 100% of the time. Not 99% of the time. It happens 100% of the time. Now, what we don't know is exactly when that reversion is going to happen. Is it going to be in a day? Is it going to be in a week? Is it going to be in 3 weeks? But it will happen 100% of the time. So in the case of MPC, we were able to combine. We were able to put together, looking at implied vol, knowing that we want to sell premium or make sure we're collecting money with a credit spread. And we combine that with the direction, looking at this right here and looking that MPC is probably at some big time support. Maybe it's not going to rally back, the 10, 15% that it's down today. Maybe it's not going to rally back in a day, 2 days, a week, whatever it is, but that support level should hold. So what did that tell me? And what should that tell all of you? Okay, it should tell us that we gotta look for something that combines a bullish position or positive delta with negative vega or negative volatility. Because what happens if we are short volatility and it goes down? We make money. What happens if we're long volatility and it goes up? We make money. Now, you might ask, how? Besides just recognizing that, okay, I see when it's up there, we got to sell it, and when it's down here, we got to buy it. How do we recognize, or how do we literally calculate how much those options could move based on a move in volatility? Well, let's see. Okay, so what I have here, this is actually the P&L chart for this position that we put on here in MPC. And you can see here, this is a bullish position. How do we know that? Well, we don't want the stock to go down here because that means we lose money. We want the stock to go higher. So we can see here the positive delta. At the same time, we have that negative vega. Does everybody know what vega is? And it's one of the easier Greeks to remember. Vega is tied to implied volatility, V and V. Easy thing to remember. Implied volatility tells us how expensive or how cheap an option is. Vega tells us how much that option is going to change in value as implied volatility changes. Okay, so having this vega of -4 in MPC, what that means is for every one, hang on, I should probably not draw that on the yellow there. Hang on, let me erase that. Okay, for every 1% that the implied volatility moves in MPC, okay, this position, because of this -4, the value of that position is going to change by 4 or $4. By 4 cents, which, multiply that by the 100 notional, gets us to $4. Because it's negative, we want to see that implied volatility go down. Does that make sense to everybody? If we had a positive vega, we would want to see that vol go up. But having a negative vega means we make money on our option position if volatility comes down, regardless of what happens to stock price, this is just reference to implied volatility. Okay, now let's reference this again. Why do we want to have that negative vega position? We want to have that because of this right here. Because looking at the charts, it tells us that historically speaking, this option premium is super expensive. Does everyone see that? Please give me a shout out in the chat if you do. If you don't, I'm happy to explain again. Okay, good. Now, that -4, okay, and I'm going to just put V next to it, -4 of vega. Well, what would be a reasonable assumption here? What would be a reasonable assumption about where we might see the implied volatility in MPC go? Even if it came down to these prior highs, okay, right around 32%. Right now, we're at 39.5%. So let's say the implied volatility decreased by about 7 percentage points. Okay, what kind of effect is that going to have on our position? And I would say, looking at this chart, the odds are way more in our favor that that implied vol is coming down than it's going up. Okay, but if the implied vol did go down 7 percentage points and our vega risk is 4 cents or $4 per point, exactly, Joselito, excellent. That means the value of this position would change by about 28 cents. Or in this case, because the vol is coming down, the value of this position would drop by about 28 cents. Is that a good thing for our position? You bet. And it is, because remember, we sold this position. We collected a credit. We received a credit, I want to say it was $2.20. I'm sorry, it was $2. We collected a credit of $2. Great. That means that something that I sold you or something you sold to someone else in the world, if that volatility comes down, is now going to be worth less, and I'm going to be able to buy it back cheaper. Does everybody understand that? That's why it is so critical and so crucial, guys, when you're putting on a position, not just to look at direction, whether you're bullish or bearish or neutral in a stock, but to look at option premium, which is the implied volatility. And when we can marry together direction or delta with implied volatility, when we can marry that together into a position, that is where we really, really can get an edge in our positions. Okay, so that's what we did in MPC, and that is why this morning we put on the type of position in here that we did, so we could take advantage of a move higher, positive delta, but also collect money up front. Somebody paid us money up front instead of us dishing it out. Hopefully that makes sense. I'm happy to go into more detail at another time. I know a bunch of you put in stocks here you want to take a look at to see implied vol, to see option premium. The first one was Palo Alto. Okay, here's Palo Alto. Huge move in the stock today. Here's an implied volatility graph right here over 2 years. Yes, Robert, that Vega was combined of all the different strikes together. That is correct. So here, what would you guys say implied volatility is in Palo Alto right now? And again, this is a 2-year chart we're looking at. Okay, I can shorten this up, maybe make it a 1-year chart. Yeah, Kent, it is low. If I was going to be putting on a position in Palo Alto today, even with this big move in the stock, whatever my position would be, bearish, bullish, whatever it would be, I would want to be buying premium or buying time, because remember, time is premium. So when volatility is lower, time is cheaper. Okay, another one was NVIDIA. Let's take a look at NVIDIA here, guys. Okay, as we populate, and while we've been on here, we've been on actually almost a half an hour. I say this every day. Can't believe how fast these things go. Market's pretty much been unchanged. Here is a 1-year implied volatility chart for NVIDIA. I'd say it's pretty darn cheap. Now, if I made this a 6-month chart, it would look even cheaper. If I made it a 2-year chart, maybe it looks a little bit more expensive, but still relatively inexpensive. So if I was going to take a position in NVIDIA, I would look for a volatility position, a Vega position that probably was a little bit long. Certainly not short. Certainly not short. Okay, does that make sense to everybody? Does that make sense to everybody? You can look at your implied volatility charts just as you would your stock charts to get areas of support and resistance. Remember, time or theta is premium, right? The more time that you buy in a position, the more time you buy in a position, okay, the more that's going to cost you. When implied volatility is lower, you're getting time premium, you're getting your option premium on sale. When implied volatility is higher, you're charging someone an expensive number. And then there's often times where we'll look at an implied volatility chart and see, yeah, it's kind of right in the middle, right? That option premium is not really cheap, it's not really expensive, it's somewhere right in the middle. So what would we do in times like that where really it could go either way, it could go lower, it could go higher? We would look to take a neutral Vega position. Still could take your directional delta position, but a neutral Vega position. Does that make sense to everybody? Sit back. Doesn't mean we don't take a position. It means we can do something that has neutral volatility. So if there is a move, one way or the other, the volatility move does not affect our position. Barry, great question. With swing trading, what time frame do you use to assess the level of volatility? So I'm going to throw one caveat out there, right? Because there's always one caveat we have to put out there when you're trading. If it is not related to an upcoming earnings release where we know volatility is going to get expensive, I like to look at 6-month chart, maybe a year chart. 3 month if you're really looking for a position that really short term, a day or two. All that can change, obviously, when we're looking at something where a stock may have earnings coming up. But, going back to Palo Alto here, if I'm taking a position here and it has nothing to do with earnings, and I look at this is a 1 year chart, man, I know right here, I am really confident that if I bought time, that change in implied vol is most likely not going against me. This chart right here says it all, that the odds are with me. Does that make sense, everyone? Because it is that time to go to the wheel. All right, let's do it. Let's do it. All right. Let's spin that wheel. There we go, guys. There we go. Today's swag is John Gebhardt. John Gebhardt, congratulations. Nicely done, sir. If you can shoot me an email with your mailing address and size swag that you would like to wear, there's the email address. Please do so. All right, guys. Thank you for tuning in today. We will be back tomorrow. And as you know, we are looking at volatility plays all the time. Before I leave, guys, we have got two different live webinars tonight. One of them, Charlie Moon, is going to talk about his AI system, talk about his AI program. If you're interested there, click on that link that you see. The other live one we have today is our gold platform, our gold program. Okay? Take a deep dive into what is fueling this massive move in gold. You've got a link there. Both of those are at 8 o'clock Eastern time tonight, 7 o'clock Central. Hopefully you guys will register for one or the other, or both. Maybe you have two screens. I don't know. If you're good multitasker, you can go to both. Thanks, everybody. Have a wonderful, wonderful day, and we'll see you tomorrow.